How bond market pricing works. The U.S. bond market is like baseball. You have to understand and appreciate the rules and strategies, or else it will seem boring. It's also like baseball in that its rules and pricing conventions have evolved and can seem esoteric at times. In the official Major League Rulebook, it takes more than 3,600 words to cover the rules of what the pitcher can and cannot do. In this article, we're going to cover bond market pricing conventions in less than 1,800 words. Bond market classifications are briefly discussed, followed by yield calculations, pricing benchmarks, and pricing spreads. Basic knowledge of these pricing conventions will make the bond market seem as exciting as the best World Series baseball game. Key takeaways. Bond prices are intrinsically linked to the interest rate environment in which they trade, with prices falling as interest rates rise. Bond prices are also greatly influenced by the creditworthiness of the issuer, from the federal government down to a junk bond issuer on the verge of default. Bond prices and yields can be calculated in several different ways depending on the type of bond and the definition of yield you're using. Benchmarks exist to track bond yields and serve as a relative measure of price performance. Bond market classifications. The bond market consists of a great number of issuers and types of securities. To talk about each specific type might fill an entire textbook. Therefore, for the purposes of discussing how various bond market pricing conventions work, we make the following major bond classifications work. U.S. Treasuries, bonds issued by the United States Department of the Treasury. Corporate bonds, bonds issued by corporations that carry an investment grade rating. High-yield bonds, bonds with ratings below investment grade, also known as non-investment grade bonds or junk bonds. Mortgage-backed securities, MBS, a bond collateralized by the cash flows of principal and interest payments from an underlying pool of single-family residential mortgages. Asset-backed securities, ABS, a bond collateralized by the cash flows of an underlying pool of assets such as auto loans, credit card receivables, home equity loans, aircraft leases, etc. The list of assets that have been securitized into ABSs is almost endless. Agency bonds, debt issued by the government-sponsored enterprises GECs, including Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. Municipal bonds, munis, a bond issued by a state, city, or local government or its agencies. Collateralized debt obligations, TDUs, a type of asset-backed security backed by any one or several other ABS, AMs, or loans. 1.45. How bond market pricing works. A bond's expected return. Yield is the measure used most frequently to estimate or determine a bond's expected return. Yield is also used as a relative value measure between bonds. There are two primary yield measures that must be understood to understand how different bond market pricing conventions work: yield to maturity and spot rates. A yield to maturity calculation is made by determining the interest rate, discount rate, that will make the sum of a bond's cash flows plus accrued interest equal to the current price of the bond. This calculation has two important assumptions. First, that the bond will be held until maturity, and second, that the bond's cash flows can be reinvested at the yield to maturity. A spot rate calculation is made by determining the interest rate, discount rate, that makes the present value of a zero coupon bond equal to its price. A series of spot rates must be calculated to price a coupon-paying bond. Each cash flow must be discounted using the appropriate spot rate, such that the sum of the present values of each cash flow equals the price. As we discussed below, spot rates are most often used as a building block in relative value comparisons for certain types of bonds. Benchmarks for bonds. Most bonds are priced relative to a benchmark. This is where bond market pricing gets a little tricky. Different bond classifications, as we have defined them above, use different pricing benchmarks. Some of the most common pricing benchmarks are on the run S treasuries, the most current series. Many bonds are priced relative to a specific treasury bond. For example, the on the run 10-year treasury might be used as the pricing benchmark for a 10-year corporate bond issue. When the maturity of a bond cannot be known with exactness because of call or put features, the bond is frequently priced to a benchmark curve. This is because the estimated maturity of the callable or put-able bond most likely does not coincide exactly with the maturity of a specific treasury. Benchmark pricing curves are constructed using the yields of underlying securities with maturities from 3 months to 30 years. Several different benchmark interest rates or securities are used to construct benchmark pricing curves. Because there are gaps in the maturities of securities used to construct a curve, yields must be interpolated between the observable yields. For example, one of the most commonly used benchmark curves is the on-the-run OS Treasury curve, which is constructed using the most recently issued used Treasury bonds, notes, and bills. Because securities are only issued by the U.S. Treasury with 3-month, 6-month, 2-year, 3-year, 5-year, 10-year, and 30-year maturities, the yields of theoretical bonds with maturities that lay between those maturities must be interpolated. This Treasury curve is known as the interpolated yield curve, or I curve, by bond market participants. Other popular bond benchmark pricing curves. Spot rate Treasury curve, a curve constructed using the theoretical spot rates of U.S. Treasuries. Swap curve, a curve constructed using the fixed interest rate side of interest rate swap. Eurodollars curve, a curve constructed using interest rates derived from Eurodollar futures pricing. Agency curve, a curve constructed using the yields of non-callable fixed-rate agency debt. Yield spreads for bonds. A bond's yield relative to the yield of its benchmark is called a spread. The spread is used both as a pricing mechanism and as a relative value comparison between bonds. For example, a trader might say that a certain corporate bond is trading at a spread of 75 basis points above the 10-year Treasury. This means that the yield to maturity of that bond is 0.75 greater than the yield to maturity of the on-run, greater than the yield to maturity of the on-run 10-year Treasury. Notably, if a different corporate bond with the same credit rating, outlook, and duration were trading at a spread of 90 basis points on a relative value basis, the second bond would be a better buy. There are different types of spread calculations used for the different pricing benchmarks. The 4 primary yield spread calculations are: nominal yield spread, the difference in the yield to maturity of a bond and the yield to maturity of its benchmark. 0. Volatility spread, Z spread, the constant spread that when added to the yield at each point on the spot rate Treasury curve, where a bond's cash flow is received, will make the price of a security equal to the present value of its cash flow. Option, adjusted spread, OAS. An OAS is used to evaluate bonds with embedded options, such as a callable bond or put-able bond. It is the constant spread that, when added to the yield at each point on a spot rate curve, usually the U.S. Treasury spot rate curve, where a bond's cash flow is received, will make the price of the bond equal to the present value of its cash flows. However, to calculate the OAS, the spot rate curve is given multiple interest rate paths. In other words, many different spot rate curves are calculated and the different interest rate paths are averaged. An OAS accounts for interest rate volatility and the probability of the prepayment of the principal of the bond. Discount margin, DIM. Bonds with variable interest rates are usually priced close to their par value. This is because the interest rate coupon on a variable rate bond adjusts to current interest rates based on changes in the bond's reference rate. The DM is the spread that, when added to the bond's current reference rate, will equate the bond's cash flows to its current price. Types of bonds and their benchmark spread calculation. High-yield bonds. High-yield bonds are usually priced at a nominal yield spread to a specific one-the-run U.S. Treasury bond. However, sometimes when the credit rating and outlook of a high-yield bond deteriorates, the bond will start to trade at an actual dollar price. For example, such a bond trades at $75.875 as opposed to 500 basis points over the 10-year Treasury. Corporate bonds. A corporate bond is usually priced at a nominal yield spread to a specific one-the-run U.S. Treasury bond that matches its maturity. For example, 10-year corporate bonds are priced to the 10-year Treasury. Mortgage-backed securities, MZs. There are many different types of MBS. Many of them trade at a nominal yield spread at their weighted average life to the U.S. Treasury II curve. Some adjustable rate EMs trade at a DM, others trade at a Z spread. Some CHEMOs trade at a nominal yield spread to a specific Treasury. For example, a 10-year planned amortization class bond might trade at a nominal yield spread to the on-the-run 10-year Treasury, or easy bond might trade at a nominal yield spread to the on-the-run 30-year Treasury. Because IMs have embedded call options, borrowers have the free option of prepaying their mortgages. They are frequently evaluated using an asset-backed securities, ABS. ABS frequently trade at a nominal yield spread at their weighted average life to the swap curve. Agencies frequently trade at a nominal yield spread to a specific treasury, such as the on-the-run 10-year treasury. Callable agencies are sometimes evaluated based on an OS where the spot rate curve, SI, are derived from the yields on non-callable agencies, municipal bonds. Because of the tax advantages of municipal bonds, usually not taxable, their yields are not as highly correlated with SI Treasury yields as other bonds. Therefore, munis frequently trade on an outright yield to maturity, or even a dollar price. However, a munis yield as a ratio to a benchmark Treasury yield is sometimes used as a relative value measure. Collateralized debt obligation, CDOs, like the MBs and ABs that frequently back STDOs. There are many different pricing benchmarks and yield measures used to price STDOs. The Eurodollar curve is sometimes used as a benchmark. Discount margins are used on floating rate tranches. OS calculations are made for relative value analysis. The bottom line, bond market pricing conventions are a little bit tricky. But like baseball rules, understanding the basics removes some of the ambiguity and may even make it enjoyable. Bond pricing is really just a matter of identifying a pricing benchmark, determining a spread, and understanding the difference between two basic yield calculations, yield to maturity and spot rates. With that knowledge, understanding how various types of bonds are priced shouldn't be intimidating. How to create a modern fixed income portfolio. Where can I buy government bonds? In general, there are two broad categories investors can consider when looking to invest in government bonds: Treasury bonds and municipal bonds. Both are options for investors seeking to build out the low-risk portion of their portfolio or just save money at higher, low-risk rates. Government bonds can also be a great place to start if you are new to bond investing overall. Treasuries and municipals are usually top-low risk bond options, also considered alongside money market accounts, certificates of deposit, and high-yield savings accounts. Key takeaways. Government bonds are low-risk, low-yield fixed income securities that can be attractive to more conservative investors or those looking for tax breaks. Treasury Direct is a website that allows investors to buy treasuries directly from the U.S. government at auction. Some of the other ways to buy treasuries include ETFs, money market accounts, and from a broker. Municipal bonds are issued by state and local governments or agencies and can provide tax-exempt interest income to qualified investors. These can be purchases through a broker or by way of managed fund or at Fed. 130. Government security. Introduction to government bonds. First, let us acquaint ourselves with some common terms to be aware of when looking at government bonds. Treasury bond, a security issued by the United States government. Municipal bond, a debt security issued by a local or state municipality. Maturity, the life of the bond. Yield, the yield offered as a return on the debt securities investment. There are several different types of bond yield and methods for calculating them. Coupon, the amount of regular periodic interest payments. Bond rating, a rating that is provided by a rating agency based on creditworthiness qualities and characteristics. Government bonds are essentially debt obligations of governments. Federal, sovereign bonds are issued by the federal government with the federal government's single credit rating backing them up. As of July 2020, the U.S. federal government holds the highest AA rating from Fitch, an AIA from Moody's, with an AI from Moody's, with an AID rating from Standard & Poor's. Both federal treasury bonds and municipal bonds use the revenues from the bonds for financing government projects or activities. These government bonds also come with some special tax advantages that make them unique in the bond world overall. 3. The type of government bond you're looking for determines where you can purchase it, so you need to decide which type of bond you would like to buy first. Buying government bonds. Treasuries. Treasury bond yields will vary by maturity. 4. As of December 2020, the U.S. Treasury bond market offered the following yields. The U.S. Treasury has made buying Treasury bonds easy for U.S. investors by offering the bonds through their website. Treasury Direct. Here's a step-by-step guide to using Treasury Direct. Treasury Direct account holders can also participate in Treasury auctions, which are conducted approximately 300 or more times per year. 5. The first step in the auction process is the announcement of upcoming auctions, which are generally declared 4 to 5 business days beforehand. This step discloses the number of bonds that the Treasury is selling, the date of the auction, maturity date, terms and conditions, eligible participants, and competitive and non-competitive bidding close times. 6. Non-competitive bids guarantee that investors will get the full purchase amount of the security at the yield determined during the auction by competitive bidding. Competitive bids specify the yield expected for security. 7. The second step of the auction process is the auction date, when the Treasury reviews all bids received to ensure compliance with the full set of applicable rules. All compliant non-competitive bids are accepted up until issue day, as long as they are appropriately postmarked. The final step of the auction process is the issuance of the securities. Securities are deposited to accounts and payment is delivered to the Treasury. 8. What you will need: a computer, internet connection, the Treasury Direct, GovLink, your social security number, and personal information. $100 to start investing. What to do? The Treasury makes Treasury Direct pretty simple. All you need to do is go to the Treasury Direct website, set up an account, start investing based on your maturity and yield preferences. The minimum for investment is $100. With $100, you can invest in Treasury bonds across the entire yield curve spectrum. 9. Additionally, investors can also buy Treasury bonds through a brokerage account. Charles Schwab, Fidelity, and Vanguard are a few of the top brokerages that offer Treasury bond investing. Some investors may also be able to invest in Treasuries through their bank or local Federal Reserve. 10. Managed funds. Many investors may turn to professional money managers for their Treasury investing. Like all asset classes, Treasuries can be invested in through several mutual funds and exchange-traded funds, ETFs. A variety of government bond ETFs are available, including short-term Treasuries, long-term Treasuries, and TIPS. Most of these ETFs have modest annual fees, often below 0.20 per year. Some of the most popular Treasury funds include SPDUR, Portfolio Long-Term Treasury ETF, SPUTL, iShares 7, 10-year Treasury Bond ETF, iShares 3, 7-year Treasury Bond ETF, I8, iShares 1, 3-year Treasury Bond ETF, SHI, SPRUR Bloomberg, Barclays 1, 3-month T-bill ETF, Bill, money market. You can also buy Treasury bills by investing in a Treasury money market mutual fund. Once you invest in one of these funds, buying and selling T-bills becomes easy. However, there are several significant limitations. You should probably open an account at the brokerage offering the Treasury money market mutual fund that you want. Treasury money market funds also tend to have high minimum investment requirements or high fees. Buying government bonds. Municipals. Municipal bonds are the second type of government bond option. They are issued by state governments or local municipalities for funding infrastructure and government activities in these areas. 3. While they fall in the same broad category as Treasuries, municipal bonds are a class of their own. They are government-sponsored, but they have their own credit rating system, which is similar to the standards for corporate bond credit ratings. 11. Municipal bond issuers and bonds are rated from high to low quality by credit rating agencies, namely Moody's, SEP, Fitch, and Kroll. Individual bonds may also come with their own individual credit rating. Below is a ratings chart provided by MISARB, Municipal Bond Ratings. Municipal bonds are also evaluated by maturity, ranging from 1 month to 30 years. Below is a look at the municipal bond yield curve for the AM municipal market as of December 2020. 12. Image by Julie Bang C., Investopedia 2020. Finding comprehensive information on the full list of municipal bond investments can be somewhat more challenging than for Treasuries. Beginning in 2008, the Municipal Securities Rulemaking Board, MISRB, introduced the website IMA for providing investors with greater transparency on municipal bonds. 13. IMA provides full disclosure on all municipal bonds brought to market. It is not a platform for buying and selling municipals. 14. 4 channels for investment in municipal bonds. Buying municipal bonds follows more traditionally with the standards in the bond market overall. Thus, most investors buy municipal bonds through brokerage accounts. However, in the municipal bond world, investors have a few choices. The MISRB suggests the following 4 channels for individual investors looking to buy municipal bonds. Full-service broker-dealer can include companies like Schwab, Fidelity, and Vanguard. Offers communication with a broker-dealer placing trades for you. Registered investment advisor, RIA, usually an advisor from a specialty firm, also offers communication with a broker-dealer to place trades for you. Self-managed account can also include companies like Schwab, Fidelity, and Vanguard. Investors place their own trades and manage their own portfolios. Managed funds, mutual funds ETFs focused on municipal bonds. 15. These 4 categories can overlap slightly in their offerings. Serious investors looking to go deep in the municipals market may want to work with a full-service broker-dealer or RIA that specializes in municipal bond investing, which can allow for the potential opportunity to take part in primary issuance of municipal bonds. Generally, institutional investors comprise the majority of primary municipal market buyers. Most investors, however, will be happy with trading municipal bonds on the secondary market, which can be done through full-service brokers, RIAs, and self-managed accounts. Managed funds. Since municipal bonds are more complex than treasury bonds, many investors choose to use managed funds, deploying the complex investment management to professionals. Below are a few of the market's most popular municipal bond funds. Ishares National Ant-Free Muni Bond ETView MUB, SPR NUD New Vein Bloomberg Barclays Short-Term Municipal Bond ETF. SPDER New Vein Bloomberg Barclays Municipal Bond ETFI. First Trust Managed Municipal ETFI. PIMCO Intermediate Municipal Bond Active Exchange Traded Fund MUNI. Tax advantages. For federal bonds, the interest earned is generally exempt from state and local taxes but subject to federal taxes. 16. For municipal bonds, the interest earned is free from federal taxes. 3. Municipal bonds are also tax-free for investors investing in bonds from their home state. The municipal bond market also has offerings for investors who manage the alternative minimum tax. 17. Some other special government bond consideration. Below are some answers to a few additional questions you may have when considering government bonds. How does the government bond bidding process work? Investors in treasuries can place competitive or non-competitive bids to obtain treasuries in the primary market. The Treasury has regularly scheduled auctions. Competitive bids are usually done through a broker. Treasury Direct uses non-competitive bids. Should I buy a government bond? Government bonds can be a great option for the low-risk portion of an investor's portfolio. They can also be a great way to begin investing in the bond market overall with little risk. Yields on government bonds range from approximately 2.20 to 3.0. 18. Many investors look to government bonds as options for consideration along with money market accounts, certificates of deposit, and high-yield savings accounts. Ultimately, the investment in a government bond is generally based on investment goals, risk tolerance, and return. Should I get a federal or muni bond? The choice between federal and muni bonds is also generally based on investment goals, risk tolerance, and return. The markets for treasuries and municipal bonds are very different, so many investors also consider the complexities of investing in each in their investing considerations. What government bond alternatives are available? For investors seeking to deploy the management of federal and DAR municipal bonds to professional investors, there can be many managed fund options to consider as alternatives to investing directly in treasuries or municipals. See the managed funds provided above for some options. Are treasury bonds a good investment for retirement? Some investors gain more from bonds than others. Are bonds a good investment? Investors must consider several factors, including the type of bond, how much interest the bond pays, and how long their investment will be tied up. Investors must also weigh their risk tolerance with a bond's risk of default, meaning the investment isn't repaid by the bond issuer. The good news is that treasury bonds, T-bonds, are guaranteed by the U.S. government. They can be good investments for those who are in or close to retirement, as well as younger investors who seek a stable return. Bonds are debt securities that are issued by corporations and governments to raise funds. Investors purchase bonds by putting an upfront amount as an initial investment, called the principal. When the bond expires or matures, called the maturity date, the investors are paid back their principal. In return, investors usually receive a fixed periodic interest payment from the entity that issued the bond. Bonds, including T-bonds, can be a good investment for those who are seeking a steady rate of interest payments. Although bonds and treasury bonds are popular, they have some disadvantages and risks associated with them and may not be ideal for every investor. This article compares the pros and cons of treasury bonds and whether a bond is a good investment for younger investors and those who are approaching or in retirement. Key takeaways. Treasury bonds can be a good investment for those looking for safety and a fixed rate of interest that's paid semi-annually until the bond's maturity. Bonds are an important piece of an investment portfolio's asset allocation since the steady return from bonds helps offset the volatility of equity prices. Investors who are closer to retirement tend to have a larger percentage of their portfolio in bonds, while younger investors may have a smaller percentage. Corporate bonds tend to pay a higher yield than treasury bonds since corporate bonds have default risk, while treasuries are guaranteed if held to maturity. Are bonds good investments? Investors must weigh their risk tolerance with a bond's risk of default, the bond's yield, and how long their money will be tied up. This investment will remain a boomer's best friend. What are treasury bonds? Treasury bonds, T-bonds, are government debt securities that are issued by the U.S. federal government and sold by the U.S. Treasury Department. T-bonds pay a fixed rate of interest to investors every 6 months until their maturity date, which is in 20-30 years. However, the interest rate earned from newly issued treasuries tends to fluctuate with market interest rates and the overall economic conditions of the country. During times of recession or negative economic growth, the Federal Reserve typically cuts interest rates to stimulate loan growth and spending. As a result, newly issued bonds would pay a lower rate of return in a low-rate environment. Conversely, when the economy is performing well, interest rates tend to rise as demand for credit products grows, leading to newly issued treasuries being auctioned at a higher rate. Types of treasuries. There are several types of treasury securities that are offered with various maturity dates. For example, treasury bills or T-bills are short-term bonds that have maturities from a few days to 52 weeks. Treasury notes or TU notes are very similar to treasury bonds in that they pay a fixed rate of interest every 6 months until their maturity. However, treasury notes have shorter maturity dates with terms of 2, 3, 5, 7, and 10 years. The 10-year treasury note is probably the most monitored of the treasury securities since it is often used as a benchmark for interest rate products such as loans. Treasury notes are often referred to as treasury bonds, which can make it confusing since a treasury bond is technically a bond with a maturity date between 20 and 30 years. However, a treasury note and a treasury bond are essentially identical except for their maturity dates. Whether the treasury security is a bill, note, or bond, the interest earned is exempt from state and local taxes. 2. However, the interest income is subject to federal taxes. 3. Buying and selling treasury bonds. A treasury note is sold by the Treasury Department via an online auction. Once the note has been purchased by an investor, there are 2 options. The investor can hold the bond until maturity, in which case the initial amount invested would be paid back when the bond matured. If the investor holds the bond to maturity, the amount that was invested is guaranteed to be paid back by the U.S. government. The investor also has the option of selling the bond before it matures. The bond would be sold through a broker in the secondary market, called the bond market. However, investors should be aware that their initial investment is not guaranteed if the bond is sold early through the bond market. In other words, they may receive a lower amount than what they had initially invested. Young investors. The interest paid from treasury bonds tends to underperform the returns that can be generated from investing in equities. However, the rate earned from bonds should outpace inflation or the pace of rising prices, which tends to hover around 2. All that said, there's still room for T-bonds in a young person's retirement account, which can benefit from the steady interest payments associated with these securities. For example, a steady return can help to reduce volatility or fluctuations in the value of an investment portfolio. Using bonds to help partially offset the risk of loss from other investments helps to achieve diversification, meaning not all of your money is in one type of investment. Also, T-bonds are backed by the full faith and credit of the U.S. federal government, meaning investors won't lose their initial investment. However, since younger investors have a longer time horizon, they typically opt for investments that offer long-term growth. As a result, T-bonds tend to represent a minority share of a younger person's investment portfolio. The precise percentage should be carefully determined based on the investor's tolerance for risk and long-term financial objectives. A rule of thumb formula for portfolio allocation states that investors could formulate their allocation among stocks, bonds, and cash by subtracting their age from 100. The resulting figure indicates the percentage of a person's assets that ought to be invested in stocks, while the remainder could be spread between bonds and cash. By this formula, a 25-year-old investor would consider holding 75 of the portfolio in stocks while splitting the remaining 25 between cash and bond investments. Investors near or in retirement. Retirees often buy bonds to generate an income stream in retirement. Their portfolio allocation changes and tends to become more conservative. As a result, the portion of the portfolio that's composed of bonds tends to rise. A portfolio that includes treasury bonds, bills, or notes provides safety and helps to preserve their savings since treasuries are considered risk. Free investments. With their consistent interest payments, T-bonds can offer an ideal income stream after the employment paychecks cease. Also, bond maturity dates can be laddered to create the continuous stream of income that many retirees seek. One type of treasury bond that even offers a measure of protection against inflation called inflation-protected T-bonds, also referred to as I-bonds, have an interest rate that combines a fixed yield for the life of the bond with a portion of the rate that varies according to inflation. 4. A bond ladder involves buying several bonds with staggered maturity dates in which each bond matures in a consecutive year. The strategy provides investors with cash on each maturity date. Government bonds, Vs. Corporate bonds. Corporate bonds are also debt securities that are issued by a corporation. Just like treasury bonds, corporate bonds have their advantages and disadvantages. Typically, corporate bonds pay interest payments, which can be based on a fixed rate throughout the life of the bond. The interest payments can also be based on a variable interest rate, meaning the rate can change based on market interest rates or some type of benchmark. When a corporate bond matures, the investor is paid back the principal amount that was invested. A corporate bond is backed by the corporation that issued the bond, which agrees to repay the principal amount to the investors. However, when buying corporate bonds, the initial investment is not guaranteed. As a result, corporate bondholders have default risk, which is the risk that the company may not repay its investors their initial investment. Whether the initial investment for a corporate bond is repaid or not depends on the company's financial viability. Since investors, there is usually more risk with corporate bonds, they tend to pay a higher interest rate than treasury securities. Conversely, treasury bonds are guaranteed by the U.S. government as long as the investor holds the bond until maturity. As a result, treasury bonds typically offer a lower interest rate than their corporate counterparts. Retirees should consider their risk tolerance when making a decision as to whether to purchase a corporate bond or a treasury security. Also, the time horizon is important when buying a bond, meaning how long the investment will be held. If a retiree is going to need the money within a few years, a treasury bond might not be the best choice considering its long maturity date. Although a treasury bond can be sold before its maturity, the investor may take a gain or loss depending on the bond's price in the secondary market at the time of the sale. Tax considerations should also be considered before purchasing any type of bond. 5. Please consult a financial advisor before deciding whether purchasing a corporate bond or a U.S. Treasury security is right for you. Advantages of treasury bonds. Although treasury bonds can be a good investment, they have both advantages and disadvantages. Some of the advantages of bonds include steady income. Treasury bonds pay a fixed rate of interest, which can provide a steady income stream. As a result, bonds can offer investors a steady return that can help offset potential losses from other investments in their portfolio, such as equities. Risk-free. Treasury bonds are considered risk-free assets, meaning there is no risk that the investor will lose their principal. In other words, investors that hold the bond until maturity are guaranteed their principal or initial investment. Liquid. Treasury bonds can also be sold before their maturity in the secondary bond market. In other words, there is so much liquidity meaning an ample amount of buyers and sellers. Investors can easily sell their existing bonds if they need to sell their position. Many investment options. Treasury bonds can also be purchased individually or through other investment vehicles that contain a basket of bonds, such as mutual funds and exchange-traded funds. Disadvantages of Treasury bond. Despite the advantages, Treasury bonds come with some distinct disadvantages that investors should consider before investing. Some of the disadvantages include lower rate of return. The interest income earned from a Treasury bond can result in a lower rate of return versus other investments, such as equities that pay dividends. Dividends are cash payments paid to shareholders from corporations as a reward for investing in their stock. Inflation risk. Treasury bonds are exposed to inflation risk. Inflation is the rate at which prices for goods in an economy rise over time. For example, if prices are rising by 2 per year and a Treasury bond pays 3 per year, the investor realizes a net return of 1. In other words, inflation or rising prices erodes the overall return on fixed-rate bonds such as Treasuries.